Hey everyone, Ace here. If you're someone who has a 401k, choosing between a target date retirement fund or specific index funds might be a tough option. You might have no idea what to pick. So I'm going to break down the differences between the two. Starting off with the target date retirement fund. Target date retirement funds provide easy to understand options that work reasonably well for most investors. With a target date retirement fund, it's going to list out the retirement year that you're shooting for on a 5-year increment. As you can see, 2015, 2020, 2025, so on and so forth. So what you're going to want to do is you're going to want to pick a year that you roughly think you want to retire. So for instance, for me, it would be the 2060 or 2065 if I want to work, 40 or 45 years. And if you haven't watched my video on basic investing, different types of assets, I'm going to link that up above for you. So you can go in and watch that and learn a little bit more about your 401k and target date retirement fund. Target date retirement funds are typically actively managed, meaning that there's some sort of portfolio manager that are looking at the different assets in the target date retirement fund and picking and choosing what to buy and what to sell. So they are managing that to try to optimize the best return for you. But the counterside to this is that they typically have more fees associated with them than a typical index fund because it is actively managed. And a common misconception about them is that they are less risky than your typical index fund. But that's not necessarily true, because in the beginning years of the target date retirement fund, they're going to be more heavily invested into stocks, and then in the later years, it'll be more bonds and cash assets as the target retirement date comes closer. And next is an index fund. What is an index fund? Well, if you haven't watched my video on basics to investing, I'll link that up above for you so you can watch that and learn a little bit more about what an index fund is. But to quickly recap for you, an index fund tracks a basket of stocks, whether that be a specific market like the S&P 500, Dow Jones, or NASDAQ, or more specific sectors like tech, retail, real estate, consumer goods, something like that. And what an index fund allows you to do is you can invest money into it and it will spread that money out between the different types of assets. So for instance, if you invested $100 into an index fund that is tracking the S&P 500, that $100 would be split between all the different assets in that index fund. Index funds and target date retirement funds are somewhat difficult to compare because of the different asset structures that they have. You're not comparing apples to apples, but it's more like comparing apples to oranges. But I'm going to quickly go over an example for you comparing a target date retirement fund to an index fund. I'm going to walk through some of the basic differences in it and what I look for when I'm choosing between the two. So there are a ton of different things that we can compare between assets and the performance of different assets, how the assets are split apart, the projected growth, different fees. But I really just look at 3 different things: the different assets that are in the fund, the fees associated with the fund, and the projected growth of $10,000 that Vanguard gives, which is a pretty good outlook. So we're looking at the Vanguard Target Retirement 2060 fund. And like I said before, the 3 things we're really going to be looking at is the different asset allocations, the hypothetical growth of $10,000, and what are the fees and pricing of that fund. So looking at the asset allocation, for the 2060 Target Retirement Fund, you have it's split between domestic bond, others, preferred stock, foreign bond, domestic stock, foreign stock, cash, and convertibles. And you can see the different percentages broken apart for each. And you might be thinking, why does that matter? Why does it matter that it's split between all the different assets? Well, it matters because depending on what market is doing well would depend on the growth that is driving that fund. So if domestic stocks are really doing well and they're in a bull market and you're heavily skewed into stocks in the beginning, obviously there's going to be more growth. And as the fund gets older and it'll switch from stocks to bonds, when you get closer to that retirement date, you're going to want the bond assets to perform as good as possible to continue that steady growth. Whereas in an index fund, as you'll see coming up here soon, you're not going to have those bond assets. It's mainly just going to be stocks. So if the stock market is in a bear market and trending downwards, you're not going to have growth or any security blanket that you would have in those bond assets. So next, we're going to look at the hypothetical growth of $10,000. If you would have invested $10,000 into this fund when it originated, which was 3/1/2012, and in roughly 8 years, you would have $21,332. That is making $12,000 on top of the $10,000 investment that you originally put in. Not too bad. The last thing we're going to look at is the fees and the pricing. So really what we're looking for is the expense ratio. How much money are they charging us to invest into this fund? And as you can see here, the expense ratio in this target date retirement fund is 0.080%, or 80 cents for every $1,000 invested. And why does that matter? Well, typically the higher fees, the more money coming out of your pocket. The less growth you're gonna have, the less money you're gonna get on your gains. Now, 80 cents to $1,000 doesn't seem like a lot, but it does add up over time compared to other funds that might have 10 cents or 5 cents to the $1,000 invested. 0.08% is a relatively low fee compared to a lot of other mutual funds, but when you compare it to other index funds, it's going to be slightly higher. And you might not even care or think it matters. You might be okay with that 80 cents per every $1,000 invested. That's really not a lot of money in the grand scheme of things. And that's perfectly fine. If you're more comfortable having or investing into that specific fund and paying that fee, no problem whatsoever. I just want you to be cognizant of the fees out there and how that can affect your investing, your profits, and your growth. Now, we just looked at the Target Date 2060 Retirement Fund, and I walked you through 3 things that I look for in it. Now let's compare that to one of my favorite index funds, VOO, which tracks the S&P 500. So in VOO, we're looking at the different types of assets that it invests into. Since this is an index fund that tracks the S&P 500, the assets that you're invested into are going to be the assets that are in the S&P 500. So for example, it's going to be Apple, Microsoft, Amazon, Alphabet, Facebook, Johnson & Johnson, etc. And the portfolio composition is going to be split between communication services, consumer, energy, financials, healthcare, industrials, IT, materials, real estate, and utilities. As I noted with the Target Date Retirement Fund, you're not going to have any bond assets in an index fund unless it's an index fund that's tracking bonds specifically. So the hypothetical growth here goes from 2010 to current date. So if we would have invested $10,000 in 2010, it'd be worth $33,000 today. Still pretty good. And the last thing we're going to look at is those fees. What is the expense ratio for that index fund? Well, Vanguard has been known to be the king of having low fees. So this index fund expense ratio is pretty low. It's 0.03% or 30 cents per $1,000 invested. That is a 50-cent difference between the Target Date Retirement Fund and this specific index fund of VOO. Now, does that 50 cents per $1,000 make a difference to you? I don't know. Ask yourself. To me personally, it does. Now, there's a lot of different ways you can slice the cake because you can invest into multiple different index funds tracking different markets or sectors, or you can invest into a Target Date Retirement Fund that more or less does that for you. So it really just comes down to what you're comfortable with, what your strategy is for investing, and what you want to go along with. And if you're someone who doesn't need your money for 20 to 25 years, you might be better off just investing into an index fund. You will get an average return of roughly 8% per year, and your fees will overall be lower. But in theory, you're going to have more risk with that index fund versus that Target Date Retirement Fund. But in the end, as I've stated before, as long as you're investing into your retirement, you're better off for the future and you're really helping yourself out. It doesn't matter if it's a Target Date Retirement Fund or specific index funds, either one will help you out and set you up for success for the future. Now remember, I'm not a financial advisor and none of this should be taken as financial advice. I'm just stating the differences between the two assets and what I personally lean towards, which is index funds due to the lower fees and the consistent average growth. But there is something to be said to just throwing your money into a Target Date Retirement Fund, letting someone else do the managing of the assets for you, and expecting to be able to retire once that year comes to fruition. If you liked this video, found it helpful, or you're just in a fantastic mood today, just tap that thumbs up button for me. That would greatly help me out. And subscribe for more content. Leave me a comment down below on what you prefer to invest into. Is it an index fund, Target Date Retirement Fund, none of the above? Let me know. And until then, I'll see you in the next video.